Hello, friends. Good morning. Today we are going to speak to Paras Matalia, who's a fund manager at Groww Mutual Fund. So this is part of our iPrudent Talk series. He's going to talk about, give you a market update, view on the markets, and also talk about the Groww Multi-Asset Allocation Fund that is launched. Let me introduce you to Paras. With over 7 years of experience in the capital markets, Mr. Mdalia began his career in equity research analyst with Samco Securities and then served as a fund manager and head of equities at the Samco Mutual Fund, where he played a key role in shaping investment strategies and delivering value to the investors. At Groww Mutual Fund, he continues to bring his deep market insights, research-driven approach, and proven expertise to design the strategies that aim at long-term wealth creation. So in today's session, he'll be sharing his insights, as I said, on the Groww multi-asset and the current market outlook. Then we will conclude with an engaging live question and answer session, giving you the opportunity to interact directly with him. Over to you, Paras.
Thank you, Rajnish ji, for the introduction, and thank you everyone today who's taken out time to be here. The flow for today's session will be very simple. We'll first go through few benefits of a multi-asset category, and then we'll talk about within multi-asset what is going to be Groww multi-asset allocation strategy. And towards the end of it, why multi-asset is a great category to look at today given the market conditions, where we'll talk about market outlook as well. And towards the end of it, we can have an interactive Q&A. The more questions that you ask, the better it would be. So please note down any and all questions that you have, and we'll be more than happy to take them up. So let's start. This is first slide is a very standard slide where we are just defining all the different asset classes. What is their primary driver? What is the objective of investing in that asset class? For example, we invest in equities to have capital appreciation. We invest in gold to inflation, hedge against inflation. We invest in debt to have regular income and so on and so forth. I'm sure you would have heard it n number of times, but again, to give a lot of emphasis here that every year a different asset class is a winner, right? And I'm sure most of you all feel that equities had done extremely well in last 5, 6 years, and it did. The markets were very kind in last 6 years. But again, if we look at data, the numbers, tell a different story. Where in out of last 7 years, 5 years were such where gold outperformed equities, right? Generally, this slide has been an eye opener for a lot of investors, where uh, they only thought that all the money is only made in equities, but that's not really the case. And one more point that I'm trying to drive here is that not every year the same asset class keeps on winning. Every year, some or other asset class, wins, and it's better to have a diversified portfolio rather than putting all eggs in one basket. If we talk about asset classes, we can see that there have been multiple periods where each and every asset class went through a period of consolidation where it did not give any returns. For example, equities from Jan 17 to March 20, we've seen multiple years of underperformance or zero performance in gold and silver as well. If we look at late 1900s, the second half of the century, there was a period of almost 24, 25 years where gold did not give any return. So again, driving the point that it's better to have a diversified asset classes in our portfolio rather than a single asset class. Coming to how do we define diversification is basically we want these asset classes to move differently, to move at different periods of time, and that is that is something that we measure via correlation. So correlation tells us how an asset class moves with each other. So for example, the correlation for gold and equities for last 15 years is negative 18%, which means if the equities are going up by 100, gold is going down by 18. So that's how it works. But in last 5 years, this correlation has broken down and both equities and gold are doing well. So this correlation is also something that keeps on changing based on what is going in the world. But again, we keep an eye on it to make sure we do get diversification benefits within a portfolio. So when we talk about diversification benefits, there are four big benefits that we get when we are maintaining a diversified portfolio. Here for the multi-asset benchmark, we've taken 60% Nifty 500 TRI. For debt, we've taken CRISIL Composite Index. For gold and silver, we've taken the INR prices. So 60% is equities, 30% is debt, 5% is gold, and 5% is silver. For equities, the benchmark is Nifty 500 TRI, and multi-asset, again within multi-asset equities, is Nifty 500 TRI. So we can clearly see whenever there is a sharp drawdown in the markets, whenever there is a crisis in equity markets, the multi-asset benchmark, which still has 60% equity, falls significantly lesser than the equity markets. So this is the first benefit. Second, if we talk about, markets, as we saw that they go through a consolidation period, and all asset classes do go through those consolidation periods. So what happens here is that when you have a mix of different asset classes, even when one asset class is not performing, you can get some or other kind of return or some or other kind of benefit from other asset classes. If you look at last 1 year, where we saw that equity markets did not give any return or negative returns, if you had 60% equity, 30% debt, 5% gold, 5% silver, you would have come ahead out of, at 3.5%. Similarly, in the past, there have been multiple periods where for 2, 3 years, equity markets didn't go anywhere. But if you had a diversified portfolio, you would have made some or other return from this portfolio. Third big benefit, if we look at a longer term data, this is from 2010 till now. If we zoom out, the returns by equity is 13.13%, but while this benchmark, multi-asset benchmark, has given a return of 12%. But the beauty of a diversified portfolio comes not from only returns, but from risk. So first type of risk that we saw is basically that it falls generally lesser. And second type of risk is the volatility of the net worth or volatility of the NAV. So in this case, you can see that for equity benchmark, that standard deviation is 17.19%, while with similar returns, the standard deviation for multi-asset is just 12.25, which means the volatility is significantly lower compared to equities, while the returns are similar. Coming to the most important point or advantage of a multi-asset benchmark is basically if we take 2 year returns, right? 2 year returns is not very short term. So what we've done from 2010 till now, we've calculated 2 year returns on every month end. And we've calculated how many month ends were negative, which means how many instances of 2 year returns were negative. And for equities, it was 21. While the multi-asset benchmark that we've created for our fund, the negative instances were only 4. So even when we talk about medium term to long term returns, the probability of getting negative returns significantly goes down. So again, summarizing 4 key benefits of a diversified portfolio. First is that it helps you during drawdown. Second is that when equity markets are going through consolidation, a diversified portfolio will help you generate some or other kind of return. Third, in the longer run, the return is not very different from equities, but the standard deviation, by which we measure volatility is significantly lesser. And last, even if we talk about medium term to long term, the instances or the probability of negative instances significantly go down. Now, let's talk about what we are going to do in Groww Multi-Asset Allocation Fund. So it's a fund that will invest in equities, debt, gold, silver, REITs, and InvITs. Now, how are we going to allocate between these asset classes? Is basically we've created our in-house data science platform called Shastra, which is basically it's a very long acronym. Basically, if we break it down in 2 parts, first is SHA, which is Strategic Holistic Asset Allocation. It helps us with asset allocation. And second is THRA, which is Systematic Technical Risk Assessment, which helps us identify a lot of risk. It helps us identify my biases, my blind spots when we are implementing the fund strategy. So Grow as a group, our core competency is in tech. Using tech, we've become the largest online broker in the country. We have one of the largest MF platform. We've also developed an in-house platform which helps us rebalance passive funds on a daily basis in an automated way. So generally, when the size of passive funds is smaller, it generally becomes difficult to reduce the tracking error. So using that technology, our tracking error is one of the best in the industry. So taking that competency of ours as a group, we are taking it into the active fund management, where it helps us take better data-driven decisions. So at the end of the day, if you want to understand using a simple analogy, we here give example of crude oil, where crude oil in its rawest form is not usable, it's not that valuable. But if it goes through a refining process, a lot of value is extracted from it in terms of petrol, diesel, gasoline, kerosene, and a lot of other petrochemicals. Similarly, the amount of data that is available today is something phenomenal that we've seen in last many years. But that refinery that we are talking about is Shastra for us, which helps us extract a lot of value from the raw data that we are getting. Again, the quality of crude oil also depends, the output depends on the quality of crude oil that we are putting in the refinery. Similarly, a lot of time, money, and effort has been spent to collect data. So basically, this is a simple six-step process where, in the first two steps, we've put the highest amount of time, energy, and money. We've spent a lot of time and money to get a lot of data from various sources, the best data providers in the world. And in the third step, basically, Shastra helps us create any kind of strategy where, say, for example, in this multi-asset fund, the strategy is going to be very clear. Objective is to have lower drawdowns, to have lower volatility, while the constraints are very simple that this fund should not become an asset timing fund where one asset class, which is not equity, dominates the entire fund. So it has to remain an asset diversification fund, which, as we talked, so that we can get those diversification benefits. So based on all the data, so more than 300 data points go into Shastra based on the inputs that I, give and my team gives into the platform. It runs through hundreds of simulations, hundreds of iterations, and then, we sit down and decide which strategy looks good, which strategy looks repeatable in the future, right? And based on that, we get a portfolio recommendation. And obviously, because it's a system, continuous improvement has to happen. Any new data set that we get, any new insight that we get, gets implemented within Shastra, and the system is keeps on evolving to become better every day. So as I told you in step three, my strategy, my philosophy of managing a fund goes into it. So Shastra is something we are introducing with Groww Multi-Asset Allocation Fund, but it can power a lot of funds. Let's understand these six steps. How do they look for multi-asset allocation fund, right? So because there are so many asset classes in the fund, the data for each and every asset class has to go into the system, be it macro indicators, be it technical indicators, be it fundamentals of equity stocks, be it liquidity and risk parameters, be it sentiment analysis around the world. Everything goes into it. And again, as I said, based on the objective, based on the constraints, it goes through a lot of simulation, lot of scenario analysis as to in every kind of market, be it sideways, be it bullish market, be it bearish market. It does a lot of scenario analysis, and then an optimized allocation comes out from the mix, which basically gives us two things for this fund. First is what should be the long-term strategic asset allocation for Indian markets, and second, based on current market data, based on current valuations, current sentiment, current liquidity, what tactical adjustments can we do within the fund to generate some kind of alpha? So if we talk about how does this work in a very hypothetical way, so when macros are improving, liquidity is improving, sentiment is great. It's a risk on sentiment. Basically, we'll have slightly overweight on equities. Debt will be neutral. Gold and silver will be, underweight. But if we are sitting in somewhere in today's world where the macros are not that great, Indian macros have improved a bit, but the sentiment is not that great. The liquidity is slightly going out of the market, and that is why you should have some underweight on equities. We should have a debt, overweight in debt, and slight overweight in gold and silver as well. So again, the determinants of equity allocation include macro indicators, valuation ratios like PE ratio, PB ratio, market cap to GDP ratio. It also includes a lot of technical indicators, sentiment indicators, which helps us, determine what is the sentiment of the markets. Even when, very good news comes into the market, but sentiment is not good, then that does not get reflected in the market prices. So it becomes very important. Liquidity has become very important in last 5 years. The last entire rally that we've seen, has to an extent happened because of liquidity. And if liquidity dries down, then obviously markets will also see some consolidation. And last, outlook. A lot of con calls happen with different companies where the management of the company will give growth outlook for their companies, which becomes an input to what kind of growth each and every sector will look like. Based on that, also we decide if the growth looks very good for majority of the sectors, then we can have an higher allocation in equities, and vice versa. For debt, again, macro indicators become an important contributor, but again, policy framework, the commentary by the chiefs of central bank of the world, the spread analysis between corporate bonds and treasuries become important, and real-time real yield movement of different maturities also become important. For gold and silver, generally the sentiment around geopolitical risk is very important. Second, each and every commodity goes through its own cycles and super cycles. Understanding them becomes very important. And lastly, trend and momentum within those asset classes. So we've outlined the investment thought process or framework for each and every asset class. When we talk about equities, it's going to be a flexi approach where we'll create a portfolio of large, mid, small cap stocks. But again, the objective is very clear to have lower drawdown, lower volatility, such that the weight in small cap stocks will be slightly lower compared to the entire portfolio. And again, large and mid caps will have a higher weight in the portfolio. Second, we do not have any particular bias towards any sector or any segment or any style. So we are not saying that we are only growth investors, we are only value investors, or we are only quality investors. Wherever we find best risk reward ratio, we will invest and position our equity portfolio in that way. Again, one important thing to note here is that the fund will maintain 1 year equity taxation, by which I mean that the fund will always have at least 65% gross exposure in equities, which means if we are having 55% equity, we should have 55% equity in the fund, then 10% will be arbitrage, where the taxation will not be impacted, but the net equity will be maintained at 55. Second, the debt portion of the portfolio is going to be managed by our debt fund manager, Mr. Kaustubh Sule. He has an industry experience of 17 years. He was prior with Axis AMC. He's very clear that it has to be a safety first approach where we'll invest in the highest grade corporate bonds and government securities, and gold and silver will be primarily invested through ETFs. So this is our tentative allocation. For equities, will generally not move beyond 50 and 70. 40 and 80 are extreme numbers when markets are in extreme scenario. Only then those kind of numbers will be visible. For debt, it is 10 to 35, commodities 10 to 35, REITs and InvITs again 0 to 10. So whenever we see opportunities in REITs and InvITs, we'll have some allocation in that as well. So coming to a key point, right? If we want to invest in MAF today, why Groww Multi-Asset Allocation Fund? So asset allocation is a very, very important decision because it determines your risk and return parameters of the portfolio. So a lot of effort has been driven here to make it a man plus machine effort, where asset allocation will be completely driven by Shastra, using a lot of data, using a lot of analytics, using a lot of real-time risk triggers as well. Second, at security selection stage, basically the stock portfolio or the equity portfolio will be created by myself and the team. But again, Shastra becomes a very important monitoring tool, which helps me look at my biases. It helps me look at the portfolio tilt and guide me to do better with changing market scenarios. We've seen many fund managers not able to change their investment process with changing market scenarios, and we can see long periods of underperformance. So the objective here is to have a co-pilot with me who can look at data at a much faster rate, find relationships that generally a human being cannot, and help me take better decisions in the longer term to help create a consistent investor experience. So again, the fund will maintain 65% gross exposure. It will be taxed as a 1 year equity taxation scheme. And again, why multi-asset is very important today. We've seen the best of the news and the worst of the news in last 3-4 months. If we had been exposed to similar news 10 years earlier, so for example, the day US imposed 25% additional tariff and punitive tariffs, the markets would have gone down by 5-7% in a single day if we talk about 10 years ago. But right now the markets are very, very resilient. We did not see a significant fall. If we talk about the best news, we've seen many tax reforms coming in last 1 year. The direct taxation rates were reduced via new regime. We've seen so many categories within the GST, which is indirect taxes, coming down. So the government is putting in a lot of efforts to revive consumption within our country. I hope that those efforts are visible in next 2, 3 quarters of earnings. But again, we are living in a very uncertain world where one small announcement from the West can, have a very big impact on our markets or have very big impact on many sectors within the economy. So it's important to have a diversified portfolio today rather than, having a very high allocation to equities till the time there is some sort of clarity, in terms of tariffs, in terms of wars that are going all around. So again, why key reasons for GrowMath is basically it's a data science powered investment platform, which generally is better than subjective calls in the longer term. Equity taxation, and again, as we just said, we are in extreme macro complexity where data-driven navigation can be a better way of investing in today's time. So I think that's it from my side. We can take up questions. I think if you have any questions, please do let me know.
Thank you, Paras, for a wonderful presentation. I had prepared a lot, list of lot of questions. But I think you have covered mostly in your presentation, all of them. Other questions don't take, that is done. So, but I still, for our clients, the Swedes, I'll just ask, so this Shastra powered investing when you're saying, so this will be, what will be the role of the fund managers in this? Everything will be powered by Shastra, even the equity, debt, gold, silver, every asset class.
So the fund manager role is in two ways. First is to design the strategy within Shastra. So what kind of multi-asset fund I want, that goes into Shastra, which then helps to optimize my strategy and will give a asset allocation numbers. That is where the role of Shastra ends and the role of fund managers begin. Where what do we take within equities, within debt, within gold and silver is something that remains with me and my team.
Okay. So, how dynamic will be the allocation? It will keep on changing based on market conditions. It will be more static. How much will be the chance and all that will happen then? Because if it is
So it's going to be a very dynamic strategy where we can rebalance every day if needed. But generally, we've seen if markets remain stable, then the allocations also more or less remain stable. Unless there is some big change in any of the data points which have a lot of weight in the system, then the weights change and we do real-time rebalancing, which means we rebalance every day. We don't have a periodic rebalance of monthly or quarterly rebalance because markets can change anytime and our allocations should also accordingly change anytime.
So how is Grow Multi-Asset, different than the other multi-asset products that are available in the market? So one is the Shastra part that you said, it will
Right.
be powered. And what are the other things that are different from the market?
So every multi-asset, if you see has a different strategy. I cannot comment about other multi-assets, but what we've seen is generally they'll have different taxations, they'll have different strategies. Some funds will have a nice asset timing approach where one asset class will become, a dominant part of the portfolio. Some funds will have, strategy where the commodity and equity parts are completely hedged. So within multi-asset, there are very different strategies. Here, we are using a lot of data points, which generally, helps more. Second, 1 year equity taxation helps with, that comfort or apprehension that generally investors have in the first get go. And basically, it's a man plus machine effort, right? We've seen many accidents happen in the past when subjective calls have been taken, and generally, a lot of fund managers, right, have been very late in terms of changing their strategy with time. So here, the probability of that happening becomes slightly lesser because of, a data-driven way, which again is our competence as a group.
So, with increasing, global uncertainties, now geopolitical tensions, with this tariff things that has come in, and with inflation, interest rates also being very volatile in last 1 2 years, we have seen. So how does these multi-asset allocation funds they position themselves for resilience to that all these
So,
macro?
as an AMC, we are very clear that, our investor experience should be great. We are coming out with an NFO after 8 months, while, you can see a lot of NFOs have been going on since last many months. We feel that the outlook for multi-asset is really good because, again, a lot of uncertainty. And whenever there is a lot of uncertainty, precious metals like gold and silver can become a great addition to the portfolio. But again, it should not be very big part of the portfolio because they also have their own volatilities. And a lot of dynamic management should come into the place when, the market data or market structure is changing so quickly. So again, if we have a diversified portfolio with gold, silver, I think within hybrid category, multi-asset as a category should do really well in next 1.5 years. Long term, we've seen it does good, but again, 1.5 years is where a lot of investor experience comes into place. So I think next 1.5 years is also something where multi-asset as a category looks great.
What's your view? I mean, your questions around is what is your view on gold and silver? Do you think they'll be stable or they will continue to give good, better returns from here?
So silver, we are seeing some kind of rally which we've not seen in the past many decades. We've seen very sharp rallies in silver and then silver falling very sharply. So we are still, understanding core reasons behind silver doing that. But we are very certain that gold will keep on doing well even for next 1.5 2 years because there is central bank buying happening in gold and we think that trend is here to stay because a lot of if you see there was an article in ET last week where for the first time in many decades gold has become number two in the reserves of central banks while US securities has become number third. So I think this trend will keep on going on which will support gold prices in the near term as well. So the outlook for gold remains well. Silver, I think you should be very cautious